How does a bank that just grew its active app users by 14% and boosted earnings by 10% annually over 3 years actually get punished by the stock market?
Yeah, I mean, it's a huge paradox, right?
Right. So today we're doing a deep dive into exactly that. We've got a stack of Philippine SEC Form 17As, which are basically the ultimate legally binding annual report cards, along with their Q1 2026 financial outlooks. And we're looking at a massive matchup. We've got Metrobank, the growth challenger, taking on the Bank of the Philippine Islands, or BPI, the institutional legacy. So, okay, let's unpack this. Do you buy the future blueprint, or do you buy the historical fortress?
Well, to really answer that, you have to look at what Metrobank is actually up against.
Yeah.
BPI isn't just an established player. They literally started Philippine banking. I mean, founded in 1851, it's the very first bank in the Philippines and actually all of Southeast Asia.
Right, so they have this insane 175-year track record. And I naturally just picture BPI as this ancient, impenetrable stone castle. But I have to push back a little here. What does that history actually buy them today? Like, is a 175-year-old stone castle just too rigid to adapt to modern high-speed digital warfare?
It totally seems that way from the outside, but that stone castle is actually a profound financial advantage because of, well, how the walls are built. BPI relies on a structural prestige that you just can't buy.
What do you mean by structural prestige?
So those walls are made of generations of sticky deposits from affluent families and legacy corporations. Because these clients leave their money there through sheer habit and deep-seated institutional trust, BPI gets access to incredibly cheap capital. They simply don't have to fight as hard for those funds.
Ah, wow. So the prestige literally lowers their operating costs.
Exactly.
And looking at the Q1 2026 outlooks, especially with all the recent geopolitical shocks, that stability acts like a magnet, right? When the market panics, capital naturally just flows to the fortress.
Yeah, BPI doesn't need to be the fastest mover because its legacy acts as a shock absorber during market volatility, which, forces Metrobank to play a completely different game.
Right, the growth challenger.
Yeah, if BPI is defending a static legacy, Metrobank is the agile army actively playing offense to capture new territory.
And looking at their strategy in these reports, it's fascinating. They're running this synchronized, dual-pronged attack. They're fiercely protecting their own moat in high-yield corporate and commercial banking, but their real midterm blueprint is to double their retail customer base.
Which is a massive undertaking.
It is. So how do they actually pay for a massive offensive campaign like that without risking the stability of the bank?
Well, that brings us directly to their balance sheet, specifically a metric called the CET1 ratio, which currently stands at a very robust 14.7%.
Okay, remind us what that means in this context.
Sure. So CET1, or Common Equity Tier 1, is essentially a financial health check. It compares a bank's core, rock-solid capital against its riskier assets. So sitting at 14.7% means Metrobank has a formidable war chest of cash. They have the highly resilient capital backing to fund this aggressive market expansion without, over-leveraging themselves.
Okay, so they have the raw funding to engineer this retail push, and we actually see the results in their digital expansion, right? The Metrobank app just hit almost 1.4 million active users, which is that 14% jump.
Huge growth, yeah.
But here is where it gets really interesting. Getting back to that paradox from the start, if their fundamentals are so strong, the app is growing, the war chest is full, why did the stock take a 3% dip after missing Q1 expectations? Like, why is the market punishing them?
Because building an agile digital army is incredibly expensive. That's the causal link the market is reacting to right now. To acquire those unbanked retail customers, design those new products, and build out that tech infrastructure, Metrobank is spending heavily.
Ah, so those rising operating costs are directly eating into their short-term profit margins.
Precisely. It creates this really fascinating valuation gap. The stock price currently reflects the short-term cost pressure of this digital rollout, not necessarily the long-term value of the market share they're actively winning.
So the market is reacting to the immediate price tag of the war, even though Metrobank is successfully capturing the territory.
Exactly, yeah.
So what does this all mean for you, the listener, looking at this matchup? The verdict really comes down to your own philosophy. MBT is for investors hungry for aggressive growth metrics and a management team actively re-engineering itself to capture new market share.
Right, while BPI is for investors who prioritize defensible legacy elite relationships and that premium structural trust that guarantees stability.
Think about the banking app on your phone right now. Metrobank is spending millions to make sure it's their logo on your screen. engineering new ways to win your daily digital business.
And BPI is betting that your family's generational trust is enough to keep your account safe behind their walls.
Exactly. So when push comes to shove, look at your own banking habits. Do you naturally gravitate toward the comfort of a generational legacy? Or are you won over by a bank actively re-engineering itself to win your business?